U.S. Bancorp surging this afternoon on news the Fed is easing regulatory requirements on the bank. We're going to hear more when it reports results tomorrow. And that comes after Bank of America and Goldman beat on both top and bottom lines this morning. Here is Bank of America CEO Brian Moynihan on what helped power earnings this quarter.
What drives our net interest income is our deposit base, which is the best in the business. And you're seeing the stability and growth in the commercial side of the house. You're seeing stability in the wealth management side. In the consumer business, consumers still spend down, but very stable, very profitable customer base.
Let's find out what this means for the banks reporting the rest of the week, including Morgan Stanley tomorrow. Joining us now, Ian Lapey, portfolio manager at Gabelli Funds, focused on financials. Ian, thanks for being with us here.
Thank you for having me.
So, interest rate impact on most banks. The narrative at first, one of them was customers pulling their deposits out for better yields elsewhere. Is that shifting now, at least for some banks?
It is. Deposits have been stable. So I think the days of panic deposit runs are over. Generally, banks benefit from higher rates. And so I think we're starting to see that now. Of the banks that have reported so far, generally the results have been quite resilient. We've seen growth in tangible book value, Tier 1 common equity, actually operating leverage for most of them, revenues growing faster than expenses. And the stocks are really cheap. It's really been a divergence between business performance and stock performance for most banks this year because they've actually, with a lot of headwinds, done quite well, and the stocks trade at high single-digit PE multiples.
Okay, among your risks for investors that you've listed here, I see geopolitics.
Yes.
Does that apply to banks in particular, and if so, how?
Definitely, and I think in my career, this is probably as bad, probably as the worst that it's been. So we saw obviously what happened in Russia and Ukraine, and I own European banks, and most of them had to exit their Russian operations. They were in a position of, generally all of them actually, of enough strength that they were able to do that, still be profitable, and European banks are actually doing really well, buying back stock this year. But we don't know what's going to happen in the future, and it is a period of considerable uncertainty. My approach is to make sure I own common stocks with very strong balance sheets and also very strong management teams that operate like owners with a long-term focus, who are really focused on risk management so that when you do have things happen that you don't expect, as we've had many times over the last, whether it's the COVID pandemic, bank runs this year, or Russia, Ukraine, well-managed, well-financed companies should be okay.
So what are some examples of that? And I ask that because the regionals in particular, they've been really beaten down. And yes, we have a lot of green on the screen today, but I'd imagine there's a big difference between value trap and value but quality.
Yeah, well, my largest position, First Citizens Bank shares, again, if you're in a strong capital position and bad things happen, you can be in a position to capitalize. So they were in a good position this year and bought Silicon Valley Bank in an FDIC auction. They paid $500 million, and in their first quarter, they reported a $9.8 billion after-tax gain. So this has actually been an incredible year for First Citizens because they were strongly capitalized, prudently managed, and ready to pounce on opportunities. So that's really what I'm looking to do, is invest in companies like that can capitalize in periods of uncertainty.
So when you see shares of U.S. Bancorp surge today because of this news of easing regulatory requirements from the Fed, do you expect that we're going to see more of that within U.S. banks, or not so much? This is a one-off.
It seems like a one-off. It seems like regulators are pretty determined with the Basel III endgame to make banks hold more capital. And you've heard bank CEOs complaining a lot about it on earnings calls at the Barclays conference a couple weeks ago. And there may be some lightening, but I think generally capital ratios are going to have to be higher for banks. For me, as a long-term investor, I actually don't mind that because, again, I like strongly capitalized banks. And I think that if banks were more stable and you didn't have bank failures like we've had this year, they would probably trade at higher PE multiples. So again, the 7, 8 PEs now probably reflect the fact that people don't want to be invested in a sector where you might have failures.
Okay. Ian Lapey, thanks for joining us. We'll see if it leads to more consolidation as well.
Yes, I'm sure it will. Okay. Not in the near term, but in the next couple of years.